You're broadly positive of Europe ex-UK versus the US for 2018. How much of a risk to that thesis is the stronger euro, which has received a big leg up today on the back of those ECB minutes, or accounts, as we like to call them here in Europe?
Hi, Mark. Thanks very much. You're exactly right. The euro level is a key risk to our view. In fact, if we look back to the performance of European markets relative to the U.S. in 2017, the differential, the outperformance in European shares is really all baked in the currency. We think the weakness in the dollar will tend to persist throughout the first half, at the very least, of 2018, but to a much less degree. So we think the bigger risk was a 2017 issue. In 2018, we think the dollar is going to be more range-bound relative to Europe, even with the minutes today getting a more hawkish tone from the ECB. So it's a risk. It's on the back of our minds, but we don't think it's going to be enough to overwhelm the fundamentals, the really strong positive fundamentals that we're seeing out of Europe.
What's the earnings outlook, Jim, for Europe versus the US this year?
The earnings outlook, we think, is broadly the same. We do expect Europe to be growing earnings at double-digit levels, a bit less on the U.S., but I think the more interesting thing is the potential for upside surprise in Europe. And the starting point with European shares at valuations which are considerably lower than the U.S. So the opportunity for multiple expansion, we think, is much more acute in Europe than it is here in the States.
Jim, you know, you're head of portfolio strategies. How have you been tweaking those strategies, if at all?
Hi, Bonnie. So great question. Broadly, we remain diversified, as we tend to always do. There are always unknowns out there on the horizon. But within our equity exposure, we do tend to overweight those areas outside of the United States. So we're looking at Europe, as we've spoken about. We're looking at Japan. We're considering emerging markets. We've been holding back and maintaining a cap weighting exposure thus far. Within the U.S., we're not looking for anything other than really a rotation in sector leadership. So while our view on U.S. markets is still positive, we don't expect it to be the world leader. And within the U.S. market, we are expecting more value-oriented names to do better in 2018, finally, after a long stretch of underperformance for the last 5 years. And we're very skeptical of bond proxies that we see here in the United States. We're not calling necessarily for rates to be rising much above 275 for 2018, but still we think that will be added pressure on those bond proxies with high quality, such as the utilities.